Now, Russia's central bank has cut its key interest rate by 50 basis points to about 15.5% in a move that has surprised the markets. 16 out of 24 analysts surveyed by Reuters had expected the rates to remain unchanged. The governor, Elvira Nabulina, said that the policymakers had debated between holding rates and then cutting by 50 basis points, but are now more confident about continuing with the rate reductions in the upcoming meetings. However, she clarified that this is not an unconditional commitment.
We have decided to lower the key rate to 15.5% per annum. The economic situation is generally developing within our baseline scenario. Weekly price data for January appears quite high, but it doesn't change the overall picture. In our view, inflation has redistributed between the end of last year and the beginning of this year, so it's more appropriate to consider the last 3 months as a whole rather than individually. I will return to this topic later. The current tightness of monetary policy creates the necessary conditions for inflation to return to the target level of 4%. Therefore, we continue to gradually ease our policy.
Now, despite the rate cut, inflation risks remain elevated. The central bank raised its annual inflation forecast to about 4.5 to 5.5% from an earlier range of 4 to 5%. This comes as reports suggest that everyday items are turning into luxuries. A value-added tax increase introduced to contain the budget deficit has contributed to the spike in prices.
First, inflation. We'll receive the full data for January this evening, but the weekly statistics already show that prices have risen significantly over the month. The main reason is the expected pass-through of the VAT increase to prices, but its effect was stronger and more concentrated in January than the similar tax increase in 2019. Most companies didn't pass the tax increase onto prices at the end of last year, but did so at the beginning of this year, so the main impact of this factor fell in January.
The central bank has also flagged oil as a key risk to Russia's economic outlook. Lower oil prices directly impact government revenues at a time when military spending remains elevated and the budget deficit is under pressure. The Reuters has reported that the deficit could widen to nearly 3 times the official target by the end of 2026. Now, adding to the uncertainty, the US President Donald Trump has said that he had reached an understanding with India to halt purchase of the Russian oil, a move that could further strain export earnings, with oil revenues forming a critical pillar of state finances. Any sustained weakness in prices could limit Moscow's fiscal flexibility.